yet another edition of a webinar on Kings of Capital. But this is also special because today we are launching what's a very innovative tool of systematically saving and investing in your selected funds. I mean, many of you would be familiar with this concept in the mutual fund area, but it's innovative in the PMS construct. So we're quite proud as a team at Marcellus for all the work that our team has put up to get this facility over to you. Just to tell you a bit more about this, I hand it over to my colleague Nitesh to tell you how the entire systematic investment plan works at Marcellus. Over to you, Nitesh.
Thank you, Pramod, and good evening, everyone. And at Marcellus, we always try to offer more, flexibility, more option to our clients. And hence we launched STP Systematic Transfer Plan a couple of weeks back, and now we are launching SIP Systematic Investment Plan. Basically, SIP is a great tool to inculcate habit of saving and investing regularly. But to be honest, that was one of the things which I missed early on in my career, where I saved but I never invested properly, and I let my money rot in bank. So in SIP, this plan or SIP tool is available for our existing clients, whose AUM is 50 lakhs or more. By signing up SIP every month, they can invest minimum of 2 lakh rupee in systematically from their bank account. It automatically comes to your PMS account and it is invested. So existing client with 50 lakh and more can opt for SIP plan. 2 lakh is the minimum ticket size, and then in the additions of 50,000. So 2 lakh, 50,000, 3 lakh, like that. Again, SIP on 7th of every month, it will be debited from your account, from your bank account that you registered with us, and it goes in the PMS account and it is invested in the equity market. Minimum tranche is 5. That means if you sign up 5 tranche, you will have to transfer 2 lakhs automatically. It will be debited. After that, you can decide to continue. You can decide to stop. That is as per your choice. The FAQs related to STP, we have uploaded on our website. On the FAQ chat box, we will share you shortly. Please reach out to your respective RMs. If you have any queries, reach out to sales, reach out to us for any queries. Again, it's a great plan system of saving and investing. That said, happy to take any queries later on, or you can reach out to us over email, and we will be more than happy to answer that. So over to you, Pramod.
Thank you. And yeah, like Nitesh said, this is quite innovative and helps people invest in a disciplined way in the PMS construct as well, as you had been doing in the mutual fund construct. So now, without much ado, we'll get to the topic of the webinar, which is why does investing in financials, surprisingly to our to popular belief, or contrary to popular belief, we believe that investing in financials is a risky or at least a far more volatile experience. However, data suggests otherwise. And I'll let our fund manager of the Kings of Capital, PMS, take you through this compounding miracle. Over to you, Tej.
Thank you, Pramod. So over the past 4 months, that since the time that we've launched Kings of Capital, we've got a few questions which are actually related to each other and are around the familiar topic of why investing in financial services can be more volatile. How does a portfolio of only financial services companies make sense? And the most frequently asked question is that if we invest in only a portfolio which consists only of financial services companies, wouldn't we see a large drawdown, say, every few quarters or every few months? Because historically, the first thing that comes to any investor's mind is stock market crash is first correlated to a financial crisis. And therefore, what we've intuitively known over the years is that a stock market crash is therefore also correlated to a steep correction in prices of banks, NBFCs, and the financial sector in general. So what we've done is we've tried to quantify why investing in a portfolio which consists only of financial services companies makes sense, how some of these perceptions, which intuitively might appear to be right, have not played out over the years. And we've tried to show with a lot of data that investing in actually financial services companies gives you better risk-adjusted returns than investing in, first of all, non-financial services companies at a sector level. That is, we've compared the Nifty and the Bank Nifty. Secondly, the difference is even more stark when we compare high-quality financials with high-quality non-financial companies. So we'll try and answer these three questions about why investing in a portfolio which consists of financial stocks makes sense, why actually a portfolio of financial services companies, of high-quality financial services companies, is actually less volatile than a portfolio of non-financial companies. And actually, we've seen historically that the drawdowns that we see in financial stocks or even in the Bank Nifty have been lower than the drawdowns that we see in the Nifty. So first of all, at a sector level, what we've seen over the past 20 years, this is data from January 2000 till September of 2020. First of all, at a returns level, the Bank Nifty outperforms the Nifty by a massive 9%. So 14% is what the Nifty 50 has delivered. And this is over a 20-year period. This is daily average 1-year rolling returns, so as to remove the bias that comes in from starting and ending point values. So 14% for the Nifty 50 versus 23% for the Bank Nifty. And this is over a 20-year period. Therefore, this difference of 9% over 20 years accumulates, and it is a massive difference. The second point being that, yes, the volatility of the Bank Nifty is higher. However, if we compare the downside deviation, and I'll give you an example in one of the coming slides. If we compare the downside deviation of the Nifty with the Bank Nifty, they're actually quite similar. And as a result of the higher risk-adjusted returns of the Bank Nifty, we've seen that the Sharpe ratio of the Bank Nifty is about 60% higher than the Nifty 50. So at a sector level itself, Bank Nifty, first of all, delivers a higher return. Secondly, risk-adjusted returns are also higher by 60%. So at a sector level, better absolute returns, better risk-adjusted returns. Secondly, what we have shown over here is that over the past 20 years, there have been 11 instances where the Nifty 50 has delivered 3 quarters of negative returns. So in 14% of cases, we've seen that the Nifty 50 has delivered negative returns for 3 consecutive quarters, versus only 5% for the Bank Nifty. So actually, well within the past 20 years, we can show quantitatively that the Bank Nifty has actually delivered lower number of negative quarters 3 consecutive times, which is actually less than half of that of the Nifty. And therefore, what intuitively seems like a more volatile sector or a sector which sees a large number of drawdowns, we've shown that it is not the case. And this is over a large period of time. So 3 takeaways from this slide. One is the better absolute return of the Bank Nifty. Second is the better risk-adjusted return, and massively better for the Bank Nifty, 60% higher risk-adjusted returns for the Bank Nifty. And the third is that even if you were to look at a shorter time period, because we've experienced this over the past 2.5 years, where we've seen the IL&FS crisis, we've seen DHFL, Yes Bank crisis, we've also seen COVID now. Even if you were to take a time horizon since April 2018, that is since we've seen all of these crises, it may intuitively appear to us that the Bank Nifty has suffered some massive drawdown and would have delivered lower returns than the Nifty. However, it's quite the opposite. Even since 1st April 2018, the Bank Nifty at a sector level, the financial services sector, therefore, has outperformed the Nifty, the broader index. So these are 3 key takeaways from this slide. Now moving towards high quality financials versus high quality non-financials. So in the earlier slide, we demonstrated how at a sector level, the financial services sector outperforms the broader index. Now over here, what we've done is we've created 11 portfolios of high quality companies. And we've defined high quality companies as, for non-financial companies, we've defined high quality companies as companies which have delivered greater than 10% revenue growth and greater than 15% ROCE in each of the previous 10 years. And for financial companies, we've defined high quality as companies which have delivered greater than 15% loan book growth and greater than 15% ROE for each of the previous 10 years. And that is how we have created 11 portfolios. The first portfolio is starting FY 2001. So for example, the first portfolio would consist of companies which have delivered greater than 10% revenue growth, greater than 15% ROC for non-financials from 91 to the year 2000. Similarly for the next portfolio and so on. And in the case of financial companies, the first portfolio would consist of companies which have delivered greater than 15% loan book growth and greater than 15% return on equity for the 10-year period between 1991 to 2000. And so on and so forth. So that is how we got about 11 portfolios. And P01 being the first portfolio would consist of, so the blue bar over here represents financial companies and the orange bar over here represents non-financial companies. So each portfolio of high quality financial and non-financial companies is divided into two parts, the blue representing financials and the orange representing non-financials. And what was surprising even for us was that across all of these portfolios, the financial companies have delivered better risk-adjusted returns, better Sharpe ratios. So across all of these 11 portfolios, the financial companies delivered better Sharpe ratios. And what is another basic thing but important to note over here is that we'll see that all the blue bars are more than zero. So they're all positive, which implies that across no time period have these financial companies generated returns which are less than a 7% CAGR return. Secondly, which is even more surprising is that not only did these high quality financial companies deliver better risk adjusted returns, better Sharpe ratios than the high quality non-financial companies across all time periods, but in 7 out of the 11 portfolios, they also delivered lower standard deviation. And what that implies is that high quality financial companies in 2/3 of the cases have also a lower standard deviation, apart from delivering in most cases higher returns, because these are leverage businesses which grow at a much faster rate. They in 2/3, in 67% cases, have also delivered lower standard deviation. So therefore, first of all, at a sector level, we've seen that financials outperform in absolute returns by a massive 9%, 23% returns for the bank nifty versus 14%. Secondly, also on a risk adjusted returns basis, they outperform at a sector level. Secondly, in the case of high quality financials versus high quality non-financials, the difference is even more stark. Not only do they deliver a better risk adjusted return across all portfolios over the past 11 years, but they also deliver better lower standard deviation in 7 out of the 11 portfolios that we analyzed since FY 2001. Now coming to the concept of downside deviation. So the example that we've taken over here is, let's take the example of two stocks, stock A and stock B. Stock A has delivered positive returns through year 1 to year 4, 10%, 5%, 20%, and 45%. So this is the table on the left of the screen. Versus stock B, even though it's been more volatile, even though it's delivered returns which are 12%, -7.0 and 7%, the standard deviation for stock B is lower at 8% or 0.08 versus 18% or 0.18 for stock A. And the reason behind this is because standard deviation is calculated around the mean of these returns. So the mean for stock A, for example, would be around 20%, and the standard deviation gives an equal weightage for all values above and below that 20% number. And therefore, we've seen that because of the 45% return that stock A has delivered in year 4, the standard deviation of stock A is much higher than stock B, despite the fact that stock A has delivered about a 20% CAGR over this 4-year time period versus a 2 or 3% CAGR for stock B. So actually, as investors, we should prefer the sort of volatility that stock A offers us, because obviously any volatility above the mean, above the 20% mean that stock A has delivered, is good volatility. Versus any volatility which is below the mean should be penalized, and actually only the volatility which is below the mean should be penalized. And therefore, when we calculated the downside deviation for the bank nifty and nifty, we saw that the downside deviation for both of these indices is pretty similar. And therefore, even though the standard deviation is higher, for the bank nifty versus the nifty, and the downside deviation we saw is similar. So even though risk adjusted returns are 60% higher, we believe that risk adjusted returns are actually twice that for the bank nifty versus the nifty, and not only 60% higher. Because if we look at downside deviation, we'll get a much better picture when we compare these two indices. The second point, and this is a query of a lot of that we get from a lot of investors, is that wouldn't we see a large drawdown for financial services stocks, and then they'll take a long time to recover. We, over the past 20 years data, have analyzed that the bank nifty takes about 8 to 8.5 months to recover from a crash of greater than 10%. That is a monthly crash of greater than 10%. Versus a number which is about 11 to 12 months for the nifty. And similarly, on average, also, even if we compare the averages, it takes about 40% higher for the nifty, about 14.5 months to recover from a crash greater than 10% in a month, versus 10 months for the bank nifty index. So even when we compare time to recover, even when we compare downside deviation, we see that at a sector level, the financial services sector is definitely not worse off than the broader index, definitely not worse off than the nifty, and it is slightly better when it comes to time taken to recover, and almost equal to the nifty when it comes to downside deviation. Now comparing stocks, comparing this when we go to stock selection, we have seen that at a sector level, the financial services sector performs much better than the broader index, than the nifty. We've seen that high quality financial stocks also perform much better than high quality non-financial stocks. But if we were to take two examples of stocks that we own in Kings of Capital and also in consistent compounders, we can see that even if investors were to correctly predict a market crash, they would be wrong half the time, because we've seen that HDFC Bank over the past 20 years has delivered a positive return, a positive share price return in 3 out of 6 cases where the bank nifty has delivered negative returns. And same is the case with Kotak. Kotak has also delivered positive returns in 3 out of the 6 years where the bank nifty has delivered negative returns. The reasons for delivering positive returns for HDFC Bank and Kotak are a bit different though. So in the case of HDFC Bank, what we have seen is that they've grown consistently at 20-25%, and therefore earnings growth for HDFC Bank sets off the PE deflation that the stock price goes through the market crash. So in all 3 cases, FY02, FY12, FY16, in all 3 years, we've seen that the HDFC Bank stock the P multiple has corrected along with the correction that the bank nifty sees. However, because HDFC Bank consistently delivers earnings growth north of 15-20%, that is what sets off the correction in the P multiple. So in 50% of cases, even if an investor would correctly predict correction in the bank nifty, that correction would not culminate into correction or delivering of negative returns for the HDFC Bank stock. And same is the case with Kotak. In the case of Kotak, what we have seen is that the P multiple does not derate along with the derating of P multiple of the bank nifty. So whether we look at FY02, FY12, FY16, we've seen that the Kotak Bank stock has actually re-rated. That is, the P multiple has actually expanded during a bank nifty crash. And therefore, Kotak has also delivered positive returns in 3 out of the 6 instances when the bank nifty has delivered negative returns. So summarizing these data points and summarizing these slides, investors in high quality financials, and that is what we've tried to build by way of Kings of Capital, by way of the Kings of Capital portfolio, they get 3 benefits. The first benefit being outperformance of the financial services sector as a whole, which we demonstrated by way of the comparison between the bank nifty and the nifty. The financial services sector outperforms on an absolute basis. It also outperforms on a risk-adjusted returns basis. The second is the advantage, the downside protection that investors get by way of stock selection, which we saw in the previous slide, which is in 50% of cases, stocks like HDFC Bank, Kotak Bank do not deliver negative returns even when the bank nifty delivers negative returns. And the third being that now a lot of investors have an opportunity to invest in non-lending financials. Over the past 2-3 years, we've seen a lot of IPOs of life insurers, asset managers, general insurers. And therefore, we've been able to allocate about 30 to 40% of the Kings of Capital portfolio to non-lending financials as well, thereby reducing the volatility in the portfolio. So three benefits that investors in Kings of Capital get, and thereby they can compound between 20 to 25%. One is outperformance of the financial sector as a whole. Second is the benefit by way of stock selection, the downside protection that you get by way of selecting and having stocks like HDFC Bank and Kotak in the portfolio. And third is the lower volatility and the benefit of the financialization of savings theme playing out over the next decade. That is what we've delivered over the past 3-4 months since we have launched Kings of Capital. And also when we did a back test of a portfolio, these are back test results from 1st April 2018. So returns since 1st April 2018, despite seeing multiple challenges, despite seeing ILFS crisis, DHFL, Yes Bank, COVID, the returns for the Kings of Capital portfolio for investors who would have invested in April 2018 in this portfolio would have been 19%, with the lenders delivering a higher return because of the higher earnings growth and the leverage business model, 21% for the lenders and non-lenders at 15%. And when we compare this return with the Bank Nifty or the Nifty, they are at 10% for the Bank Nifty. Return for the Bank Nifty is 10%. And 8% for the Nifty. So like I said in the earlier slide, even during this 2.5 year period, the Bank Nifty itself has outperformed the Nifty. So this at a sector level, the financial services sector has outperformed the broader index. And the Kings of Capital portfolio on the back test since 1st April 2018 has delivered a higher return than the Bank Nifty. Also a better risk-adjusted return, a higher Sharpe ratio. Now the reason behind this is the table on the bottom left. Because the Kings of Capital portfolio has invested in companies which deliver sustainable ROEs north of 15% and earnings growth upwards of 15% consistently, the earnings CAGR of the portfolio, even during the past 5 years, where we've seen multiple challenges, has been 19%. Versus 7% for the Bank Nifty and just 1% for the Nifty, along with ROE also of 19% during FY20 versus 10% ROE for the Bank Nifty. And as a result of the 19% earnings growth, the 19-20% ROE, it is a similar sort of number that the share price has also delivered, despite what we have seen play out in the financial sector over the past 2.5 years. So the 19% number is tallying with the 19% returns over the past 2.5 years. And actually, the 100% of the returns have come through earnings growth, and it's not come through P multiple expansion. Now, to give an update on the lenders specifically in our portfolio, because the lenders have seen multiple challenges over the past 6-9 months during COVID. So while the non-lenders have actually flourished, we've seen life insurance, health insurance, broking businesses grow at about 30% plus over the past 6-9 months. The lenders have actually seen challenges. They've seen challenges on the NPA front, collection, disbursement, etc. So to give an overview of the lenders in the Kings of Capital portfolio, the moratorium book in April 20 for the lenders in our portfolio on average at a median level was 27%. So this was half of what the sector saw. So RBI in its financial stability report stated that about half of all loans in the financial services sector are under moratorium. So in the first month itself, in April 20 itself, we were at half of what the sector was at. By June 20, the moratorium in the portfolio was at a median level at about 12%. So it had less than half from the 27% number by June 20 itself. Now, because the lenders in our portfolio are very, very well capitalized, we can see that the Tier 1 capital adequacy is in September 20, after providing for most of the NPAs, after providing for about 10 to 12% of the moratorium book, the Tier 1 capital adequacy is at about 18%. And this, when we compare to the tier 1 capital at a sector level, which is around 10-11%, is again twice of most other banks, most other NBFCs. So this is the double benefit that the lenders in our portfolio have enjoyed through the COVID crisis. Because they had about 18% tier 1, they were able to provide for the moratorium. And secondly, the provisions that they had to make were lower, because in the first place, the moratorium for the lenders in our portfolio was half of that of the rest of the industry. And as on September 20 itself, about 10 to 11% of the moratorium book has been provided for. So we believe about 70% of the provisions that the lenders will need to make for the COVID crisis, it's already been made. And therefore, whatever we'll see in December or March quarter will be the remaining 20%. So while the NPA percentage numbers have been masked because of various dispensations provided by the RBI and then the Supreme Court case, the NPA percentage numbers will look lower temporarily till these dispensations are waived off. But the provisions for the well-run lenders have already been made. 60-70% of the provisions have already been made. So the impact on the P&L, we believe it will now only be incremental. Because these lenders were in a position, because of their excess capital, their excess tier 1, to make these provisions upfront before they were required to do so. So we launched the portfolio on 28 July. It's been now about 4.5 months since we launched in the portfolio. And these are the returns since inception, 23% for the portfolio in absolute terms over the past 4.5 months versus 33% for the bank nifty. The reason for underperformance is twofold. First of all, it's a short period of time, but otherwise also the reason for underperformance is twofold. One is optical in nature. This is TWRR returns. So if we were to compare the returns of the first investor in KCP versus the bank nifty, the returns of the first investor are around 26.8%, 27%. And the second reason being, as we saw in the earlier chart, the non-lenders in the portfolio had already recovered and they did not suffer through the COVID crisis. So if we were to break down the 26-27% returns of our portfolio into two parts, lenders and non-lenders, the lenders have delivered about 37% versus the non-lenders have delivered about 6-7%. Since July 20. So the lenders have actually outperformed the bank nifty, while the non-lenders have underperformed the bank nifty over this time period, because they did not see such a large drawdown during the COVID crisis. So yeah, that's it from my side. We can go to Q&A.
Okay. So as expected, we've got a lot of questions for you, Tej. So we'll start with the elephant in the room, in the sense, we're still in, while a number of macroeconomic indicators are suggesting a recovery in the economy, we're still not completely out of the woods. And given that a lot of our companies in the portfolio are lenders, which are leveraged by definition and also exposed to any sort of weakness in the economy, which could result in defaults from their borrowers, how confident are we in terms of our assessment of our lenders being able to face this sort of a challenge?
Right. So, just so, like we saw for the lenders in our portfolio, the tier 1 itself is at 17.5%, 18%. And the rise in NPAs is something that we have seen during the global financial crisis in 2008-9. That is something that we saw in the NBFC crisis of 98-99 as well, when NPAs actually doubled even for the likes of HDFC Limited during the NBFC crisis. NPAs doubled for HDFC Bank during the global financial crisis. And along with NPAs doubling, we also see during a financial crisis, we also see a correction in share prices due to the deflation and the derating of PE multiples. But it is the high quality lenders who have access to enough capital, who have access to not only tier 1, but also the ability to raise deposits consistently during a crisis, that are able to not only survive through the crisis, but are also able to gain market share post the crisis. So for example, through December, through March, if we assume that we'll see 3-4% of assets getting written off for the lenders in our portfolio, worst case, even if we assume that that happens, we'll see that on average, the tier 1 for lenders in our portfolio will go down to 14-15% from the 18% number in this slide. Even then, they'll be well positioned to not only provide for the NPS, but also grow through the next 3 to 4 to 5 years. Because at an industry level, on average, tier 1 is at around 10-11%. If for the lenders in our portfolio, we see write-offs to the amount to the ilk of 3 to 4%, then definitely the lenders at 10% tier 1, if they see write-offs of 4, 5, 6%, we'll see that the lenders in our portfolio will gain market share over the next 3 to 5 years. And they'll also see lower NPAs because of their ability to lend to better rated borrowers, better rated corporates. So this is something which has played out in 2008-9 in the global financial crisis, and also in the crisis of the 1990s, late 1990s, where we have seen that high quality lenders gain market share, and it is actually to their advantage that the NPAs rise.
Sort of link that, Pramod, to the broader economy. One of the reasons in middle of March when we decided that we will come out with Kings of Capital was that if you look back at the last 50 years, India's economic cycle actually has been fairly predictable. An Indian economic cycle takes off, i.e. recovers on the back of a US recession. And we've showed this sort of in several slides. A US recession brings down the cost of capital. The US 10-year bond yield goes down by 2.5%. The RBI then passes that on to borrowers in our country. That cycle has played out to perfection this time round. US 10-year bond yield was 2.5% in Jan. It's near zero by April, May. And over the last 6 months, the RBI has cut the cost of money by 2.5%. And in parallel, a US recession not only leads to the cost of money falling, it also brings down the price of oil by 50 to 80%. And on the back of cheap money and cheap oil, India recovers. Now, that's sort of, at one level, it sounds very theoretical, but we can see it practically playing out. In the channel checks that we have done over the past month, we can see that the Kings of Capital are now increasingly dominant, whether it's in providing consumer durable financing, where in many consumer durable stores, Bajaj Finance is the only financier left. Bajaj Finance is borrowing in the wholesale money market at 4.5%. A good 2.5% cheaper than even other credible lenders being, say, people like Shriram Transport or Chola. Bajaj Finance is borrowing 2.5% cheaper, and because of the chart that we are staring at, the chart that Nitesh has shown, Bajaj Finance, in spite of having heavy provisioning on the back of COVID, still has a capital adequacy ratio pushing, I think, 23%, right, on that chart. So as a result, you've got a strong lender, low cost of money. Result in the high streets of our countries, most consumer durable store, Bajaj Finance is not only the leader, they've been a leader for the last 5-6 years. They're almost the only lender providing consumer durable financing. If we look at the two-wheeler meetings with two-wheeler dealers over the last month or so, HDFC Bank once again in pole position in two-wheeler financing with some of the lowest two-wheeler financing deals we've seen in Indian history. If you're willing to put up, we were at a Royal Enfield store last week, 200 kilometers north of Bombay, and the showroom owner was telling me that if you're willing to pay 35% upfront for the bike, for the Royal Enfield bike, HDFC Bank is giving you financing at 6.99%, which is unbelievably low for two-wheeler financing. So these are not theoretical things that we're just doing on a spreadsheet. We can see how COVID is playing out in terms of strengthening the hand of strong lenders who in turn are pushing cheap money into the economy, thus driving an economic recovery.
Great. It's an interesting question, Saurabh. I guess you'll be able to throw some light here. Is we've shown the experience of Nifty and Bank Nifty. If we were to do a similar cut between, say, CCP and KCP, Would you reckon KCP would deliver a better risk-adjusted return than CCP? And currently, which is on a lot of our clients' minds, a good thing is a lot of our clients tend to be repeat investors. People have put in money in CCP, have put in money in Little Champs, are interested in putting money in KCP. How should they then go about allocating their money, a proverbial sum of 100 rupees between our portfolios, given your take on the relative risk-adjusted returns?
Yeah. So if we do CCP excluding the financial services companies, right? Remember, we'll have, from CCP we'll have to take out HDFC Bank, Kotak Bank, HDFC Life, and Bajaj Finance. If we do CCP excluding the financial services companies, it'll push down the CCP return a notch. Tej, can we go to that slide where you show the Sharpe ratios for the Kings of Capital? I think there's the chart, the slide where you have on the top left, you have the chart of lenders and non-lenders. Let's just go there because I can then use the volatility numbers there, the standard deviation numbers there. So Pramod, if we take out from the CCP, the four financial services plays which sit inside CCP, it'll pull back the CCP return from the typical 20% that CCP guns out. It'll pull it back by, I suspect, 2-3 percentage points. We'll have to do the maths. By itself, CCP X financial services, CCP will be clearly low volatility. CCP itself has volatility comparable to CCP volatility is around 8-9%. So if you see here on the chart, on the table on the top right, Kings of Capital standard deviation is 29%. CCP standard deviation says 9-10%. So because CCP standard deviation X lenders will be so low, 8-9%, which is actually comparable to a Government of India bond, CCP's main attraction is super low volatility, right? Because X the financial services plays in CCP, you're looking at 7-8-9% standard deviation, similar to a Government of India bond. Half the volatility of the Nifty, half the volatility of Kings of Capital. So CCP's big attraction is you can gun out, say, high teens returns, excluding the financial services plays, at unbelievably low volatility, thus giving you high Sharpe ratios on CCP. Kings of Capital, as a lending play, because you're getting returns which are significantly better than the Nifty, you're gunning out good Sharpes. I reckon CCP Sharpe ratios, excluding the financial services plays, will be better than Kings of Capital. Kings of Capital's raw returns, the 19% return that Tej's backtest is showing here, the table on the top right, first row, 19% return. That 19% return, CCP might be a little lower than that, but CCP will be low volatility. And hence, our consistent suggestion to clients out there is, for every Indian household out there who can afford it, CCP should be the dal chawal, the foundation of your portfolio. So if you're a South Indian, then the idli sambar of your portfolio should be CCP, because it's giving you high teens returns with the lowest volatility of any portfolio I have seen in my investment career, right? A combination of Nestle, Asian Paints, Divi's Lab, Abbott, Dr. Lal Path Labs gives you unbelievably low volatility for solid returns. What KCP is basically the main course. It's the sort of veg dish, or if you're a non-vegetarian, the chicken dish. It's the main course. Why? Because KCP is giving you a kicker on your returns. It's giving you 3-4-5% extra returns with volatility which is still comparable to Nifty, right? So to one third of your portfolio, I would suggest you should think about as KCP. 2/3 of your portfolio should be CCP, right? But the merits of adding a KCP, making the KCP 2/3, making the KCP 1/3 of your portfolio, is that you juice up the return without adding unnatural amounts of volatility. CCP itself is giving you high teens returns, 20% return, and Rakshit showed in the previous webinar, including the financial services plays with low volatility. Add KCP, push the return a little north of 20%. And it increases the standard deviation, but you end up with portfolios which are still lower than Nifty in volatility, returns significantly north of the Nifty. Where you get stuck in India, I reckon, most people, most HNWs that we present to, they get stuck with things like gold, even the Nifty, right? Nifty, you can see returns have been 8% over the last 2 years. Inflation for people like us, right, already is 7-8%. So if you're compounding only at 7-8%, which unfortunately is what the Nifty has delivered for the best part of the last 10 years, Tej has shown the last 2 years here. even if you take the last 10 years, Nifty has been doing 8-9%. That unfortunately is not going to be enough to create wealth for you. To create wealth for yourself, you need to be pushing significantly north of 10. In our view, you need to be pushing closer to 20. CCP does that with extremely low volatility. Kings of Capital adds a little bit of volatility. 2/3 CCP, 1/3 KCP would be the way to go, I think, from an ideal perspective.
Fair enough. An interesting question is on the global experience. If you look at the Western developed markets, do you see a similar trend of financials outperforming the non-financials on a risk-adjusted basis? And a couple of our clients are have been following us, referring to fund managers like Terry Smith, who have categorically said that they are not interested in investing in financials.
So there's a good reason for that. There's a good reason for Terry's reticence to invest in Western financials. So if you see the Western world, if you do say the FANG stocks, you do Unilever, L'Oreal, PayPal. So if you do a high quality collection of non-financial stocks in the developed world, you can get ROCs pushing 20%. But unfortunately, in the Western world, even the best financial services plays have ROEs of 10-11%, right? So the challenge in the Western context is Western financial services, and we're talking about, healthy Western financial services companies. So say the best investment banks, the best life insurers, 10-11% ROE versus say the FANG stocks or a PayPal, L'Oreal, Unilever type, ROE is pushing 20%, right? So the differential is huge. And as a result, compounding in the Western world from financial services, even with the best financial services, is very hard. And they really aren't monopoly plays with high barriers to entry. Just one sec, that's my COVID. So the reticence of a Terry Smith to invest in a financial services portfolio arises from that it's very, very difficult for a Goldman Sachs or for a Wells Fargo or for a Lloyds Bank in the UK to have consistently mid-teens or low teens ROEs. Even low teens is difficult. And hence his point of view is, why should I do that? I will do the equivalent of a consistent compounder stocks abroad. PayPal, L'Oreal, Unilever, those are the sorts of things that sit inside Terry Smith or Lindsay Train's portfolios, right? In our country, we don't yet have that problem. As Tej is showing on the table on the bottom left, you can see ROEs, return on equity for the Kings of Capital, is pushing 19%. And this is, as Tej said, these are through difficult periods, right? Yes Bank, ILFS, COVID. And in spite of that, you're doing ROEs of 19% in a country where the Nifty ROE is 10%, right, or 12%. So in our country, the premium financial services plays are giving you a return well above your cost of capital, and therefore they have a compounding engine going, which Tej has shown beautifully in his slides. You don't have this luxury in the Western world of high ROEs from financial services plays. I think another 20 years out, we too will be like the West. As our country matures, the ROEs on lending plays will come down. But until such time, the next 20 years, basically the financialization of India, until India financializes, until the audience who's dialed into this call financializes their wealth, we'll have high ROEs from investing in quality financial services companies. And that's what we're trying to profit from in Kings of Capital. You don't have the luxury of doing that in the Western world.
Fair enough. The next one is in terms of timing. People are saying that you guys got the timing right in the middle of the pandemic, when everybody was concerned about the economy and financials. You went ahead and launched this fund. So far, it's done well. Does it mean that you should invest in financials or Kings of Capital only in the 2 or 3 years post a crisis, or can one look at a perpetual holding like in CCP? For Kings of Capital.
If you want to take that, Tej? Yeah, sure. So I'll take 2 examples. Say if someone would have invested, if we look at the chart over here on the left of the screen, we're showing the lenders in our portfolio. We are also showing the non-lenders in our portfolio. Since 1st April 2018, we would have made till the Feb of this year, till Feb 2020, which was the peak that the portfolio reached. The returns would have been about between 25 to 30%. And within this time period, even when we saw COVID, the portfolio is back at the level it was in Feb. So it's been 8 months now that in October the portfolio, or in November the portfolio is back at the level that it was before COVID. So even if someone were to invest at the peak of peak before a crisis, say someone were to invest in 2008 at the peak or before COVID, as in the example that I took, over a 3-year period, as long as your horizon is longer than 3 years, it does not matter when you invest, because the returns would then start mimicking what the earnings growth of the portfolio is. Like we have seen in the case of COVID as well, the portfolio is back to where it was before COVID in a period of 8 months. However, if the time horizon is less than 3 years, then timing starts mattering. As you start increasing your time horizon to 3 years plus, the difference between investing between COVID in say April, May, June, or investing right now, the difference would be say 1 to 2% on a CAGR basis if you have a time horizon of greater than 3 years, and that is true as true for Kings of Capital as true it is for consistent compounders.
I think another way to just sort of articulate that is, if you assume PE multiples for high quality life insurers, general insurers, banks, NBFCs, PE multiples or PB multiples, price to book multiples, stay broadly where they are, right? So as this chart on the top left is showing, we had that plunge and now we sort of broadly back to pre-plunge levels, so to speak. If you assume PE multiples and price to book multiples stay where they are, the return we'll get is the same as the book value growth. So if book value grows by 18, 19, 20, 21%, your returns will grow at the same rate, because the odd assumption is price to book is the same. Now, in that context, across the world, price to books go through, as everybody knows, price to book goes through a cycle. If you buy our argument that you're in the early stages of a economic recovery, naturally, therefore, over in the next 3 years, the price to book of lenders will re-rate, and the returns you might make over the next 3 years will be higher than the book value growth. But if you take as Tej is saying, take a longer than 3-year view, take a 6-year view, take a 5-year view, your growth in your compounding will be broadly the same as the book value per share growth, which should be in the vicinity of 20-odd%. If you believe in the re-rating, you get a bit more than 20%. If you don't believe in the re-rating, or you say I'm here for the long run, you should be gunning out 20%. And by the way, there is obviously lots of data on HDFC Bank, Kotak Bank, Bajaj Finance now over long periods of time. So HDFC Bank from 95, I think, is 27% compounded. Tej, correct me if I'm wrong.
Yeah.
HDFC Bank from 95 is 27% compounded. Kotak Bank from 2004, right? 2004 is the IPO. From then, it's I think around 22-23% compounded. Bajaj Finance since 2008-9, they were a very small company, barely 2,000 crore loan book. From then till now is I think 27-28% compounded. So even if you assume that these numbers were from an era where we were like a Stone Age economy in terms of financialization, you should still be able to gun out 20% on a consistent basis with high quality financials purely on the basis of book value per share compounding, rather than expecting a re-rating or de-rating.
I think this is a pertinent question. Some have referred to Terry Smith's own questions around how accounting in financials tends to be a lot more dodgier than the rest. And also we've also experienced how accounting in lenders particularly tends to be a bit subjective. How does Marcellus go about making sure that we are not falling into the same trap? We've seen a whole host of banks and NBFCs come out with skeletons out of the closet and falling apart. How do we prevent accidents in KCP?
Tej, do you want to use the slides from your forensic presentation? And in the meantime, just take us to that provisioning slide, and I'll talk about that. In the meantime, if you could just pull out the forensic framework slide. Yeah. So while Tej gets the forensic framework lined up, what we have tried to show you, right, and we have tried to sort of look at this very carefully ourselves, is how the lenders that we have invested in, how much have they how much of the moratorium book have they provided for, right? Because our biggest fear, everybody's biggest fear is, A, you end up with heavy provisioning, and then B, you end up with heavy hits on the morat book, and B, it turns out that the morat book wasn't provided for, and you end up with earnings growth getting smashed through 2021, 22. And what we have taken a lot of comfort from is not just the morat book going down, which you could argue, taking Pramod's cue, the morat book going down could be entirely just, basically fiction being trotted out by the lenders. Even if you assume that's the case, the heavy provisioning on the morat book gives us a lot of comfort. And the fact that banks like HDFC Bank, Kotak Bank, and Bajaj Finance and NBFC, even after doing heavy provisioning, even after setting aside large sums of money for loan losses on the morat book, even after that, they have 18-19% capital adequacy ratios, is what's given us a lot of comfort to load up heavily. By the way, I should disclose, I was the first investor in Kings of Capital back in July, and that's exactly how we thought it through, that the morat book is coming down. Chalo, let's be cynical. Maybe that's just a fiction being trotted out. The provisioning on that is real, right? Why would you otherwise, as HDFC, Kotak, Bajaj Finance, why would you be providing so heavily, hitting your net worth in such a difficult hour? Clearly, you are being cautious. You're being conservative. Then you look at the capital adequacy ratio after the provisioning, and you still realize 18-19% capital adequacy ratio. We know from RBI documents that 99% of the financial system cannot afford these sorts of capital adequacy ratios, and therefore you think 2 steps ahead. You look forward to the NPA numbers being announced next year. You look forward to the competition being wiped out, and you look forward to the monopolization of the lending industry. Tej, over to you on the forensics.
Yeah, sure. So this is our investing funnel on Kings of Capital. So we start off with the financial services universe, and the first step for a stock to come into Kings of Capital, the first filter that we run is our forensic accounting filter. And this is to precisely eliminate the problem that we've been talking about. This is to precisely eliminate companies which do dodgy accounting, which have poor standards of corporate governance, and this is much more truer for lenders in the portfolio across CCP and KCP, because these are leverage businesses. If there is any accounting fraud or if there is any accounting jugglery, we'll see a large correction in the share price of lenders, because they are leveraged 5:1, 7:1, 10:1. Therefore, the first step for us in KCP is to eliminate companies which are poor quality accounting. And actually, 1/3 of the universe gets eliminated in our first step itself. So starting off with the 95 companies who go through the forensic filter, about 30 of them get eliminated because of our forensic filter. And the way we do this is we have a set of about 11 accounting ratios, which have been specifically designed for these financial companies. And these 11 accounting ratios, they rank these financial companies into 10 deciles, D1 being the best decile and D10 being the worst score or the worst decile. Some examples of the ratios that we use from the income statement are fee income as a percentage of net interest income, volatility in net interest income yields, and similarly a few ratios from the balance sheet as well. And this clearly differentiates high quality financial companies from the other lenders, other financial companies which do not make it to our portfolio. For example, fee income for Yes Bank was twice as high as most other lenders, 54% for Yes Bank versus 28% for Kotak. So something like this is clearly a red flag for us. And basis the total scores from these 11 ratios, we get to a score which is on the bottom left of the screen. And then we've tried to find out the correlation between share price returns and the accounting score. And we see that there is a direct correlation between the accounting score. Companies which are in the top 3 deciles, D1 to D3, these are the only companies which have actually delivered positive returns over the past 5 years, from FY16 to FY19, past 4 years. And the difference between companies in the zone of quality and companies in the zone of thuggery is massive. Companies in the zone of thuggery, which is D8 to D10, they've delivered minus 25% CAGR versus a 10 plus 10% CAGR for companies in the zone of quality, which is D1 to D3. So we put a lot of focus on accounting quality, on checking out earning statements, on annual reports, and also on the softer aspects, that is the quality of the board, continuity of auditors, related party transactions, etc., before these companies make it into our shortlist.
Right. One question is on valuations. Again, high quality companies have almost rebounded back to their pre-COVID peaks. Does that mean that much of the run-up is done? And how do you go about reconciling the valuations of some of these high quality lenders?
Yeah, sure. So, like we showed on the previous slide, these companies have actually grown in line with their earnings growth. There is no share price movement which has come through PE multiple expansion. If you look at the share price returns, 19% for the portfolio, and you compare that with the FY15 to FY20 earnings CAGR, which is also 19%, both of these numbers are moving in line. So, for example, if the share price returns number would have been 19-20% with earnings growth at 14-15%, then about 30% of returns would have come from PE multiple expansion. However, that is not the case. 100% of share price returns for our portfolio has come through earnings growth. Because we believe that the lenders in our portfolio especially are very well positioned to consolidate market share, just like it has been the case in the global financial crisis or any other previous crisis, the earnings growth should only accelerate from over here. This 19% earnings growth has come at a time when we saw demonetization, GST, IL&FS crisis, COVID. And at a time like this, if they've been able to grow at 19%, let's conservatively assume that they keep on growing at 19%. Then the share price return should follow, just like it has over the past 2.5 years, despite such difficult circumstances. So therefore, even if we were to not factor in the consolidation, the financialization theme, the financialization thesis, we believe that 19-20% sort of returns are very, very much achievable over a 3 to 5 year period.
So Pramod, if you don't mind, I'll just take that point that Tej has made and invert it in response to the question. So if you look at this slide, right, if you look at the table on the bottom left, Nifty EPS CAGR, FY15 to 20 is 1%. By the way, Nifty EPS CAGR 1, 3, 5, and 10 years is close to 0, right? And yet Nifty compounding is around 8%. So the table on the top right, the final row, Nifty returns compounding is 8%. So simple point that I'm trying to make is, rather than worry about Marcellus's portfolios, KCP or CCP on a PE multiple ground, most people on this call should be worrying about the rest of their portfolios, right? As we have seen over the years, what Indian HNWs typically do is they will have 2-3 PMSs, couple of AIFs, 4-5 mutual funds, and they'll probably have a direct stock portfolio as well. And in this manner, they'll spread their wealth across pretty much the whole stock market. And as we've repeatedly highlighted over the last couple of years, within the Indian stock market, you only have around 30 powerful compounding engines. But if your wealth is exposed to another 170 stocks who are like the Nifty, EPS compounding strength low, right? EPS compounding strength near 0, but the share prices have compounded, your problem actually lies not with KCP or CCP. Your problem lies in the rest of your portfolio. And that's exactly why we came up with the STP and the SIP, so that rather than spraying your wealth hither and thither and getting pounded on your compounding, you can on a consistent basis, load up on KCP, CCP stocks, and invest in companies with a real compounding engine, right? If you invest in companies which are typical Nifty companies, you'll end up, if you've ended up with 8%, how much of that is genuine earnings compounding? 1% at best. Rest of it is PE re-rating, and that's where you're really exposed because you're investing in companies with no real engine for compounding, and therefore when the market gives way, the wealth evaporates. On the other hand, with stocks like the KCP stocks, as Tej is showing you, earnings compounding 19%, portfolio compounding 19%. Rakshit showed you in the previous Marcellus webinar, Rakshit showed that over 1, 3, and 5 years, CCP stocks as the EPS compounding and returns are identical in the 19-20% vicinity. So you're in solid ground here. The quicksand in Indian investing is elsewhere. And so that you don't get stuck in the quicksand, we have worked very hard to come up with the first the STP and now the SIP offering.
So on that subject, I think there are quite a few distinct questions, but all pointing to a common answer. This thing about the sustainable compounding engine you talked about, obviously some of our existing clients can relate to, repeatedly talking about barriers to entry or competitive advantages. Now, how are barriers to entry different in financials versus elsewhere? That's been, a few people have asked that question. Related to that, I'll combine a couple of other things. Somebody's talked about how, there is an artificial entry barrier in banking because you need a license from the RBI. Now the RBI's working committee is talking about opening up for larger corporates, so on and so forth. Plus, there's also disruption from the typical non-financial companies through fintech and so on, say an Amazon, or how Ant Financials is built, a large financials business without a license, so on and so forth. So I think worth helping our clients understand what do we look for in that process of finding entry barriers within financials, and why fintech or new bank licenses is or is not a threat to KCP.
Sure. So let's split it up into 3 sources of comparative advantage that I think pretty much every company in KCP plays. I'll split it up, Tej, and then we'll allocate it. You take some, I'll take some. So let's split it up into technology and the ability to use technology to drive superior analytics, whether it's HDFC Life and life insurance, ICICI Lombard in motor insurance, or Bajaj Finance in credit analytics. So we'll discuss technology as a barrier to entry and how increasingly premium players in Indian financial services are using that fintech basically as a barrier to entry. Second, let's focus on capital allocation, the promoters or the CEO's ability to prudently, rationally allocate capital over long periods of time as a barrier to entry. And the third aspect, let's focus on the ability to build sort of reputation and networks. The two go together. A network without reputation is useless. A reputation without a network to gather business is useless. So let's focus on that third aspect. So Tej, you kick off. You take the first two, and then I'm happy to take the reputation and networks piece.
Yeah, sure. So taking the example first of Bajaj Finance for advantages, competitive advantages related to technology and fintech. What Bajaj Finance has done since 2008-9 in the new avatar, since Rajiv Jain and Nanu Kamnani started building out Bajaj Finance again from scratch, they inherited a 2,500 crore rupee loan book, which was 70% into vehicle financing, and it was a captive financer of Bajaj Auto. From that, they built out a 1.5 lakh crore diversified loan book across mortgages, consumer durable financing, rural financing, and multiple other business lines like personal loans, digital loans, gold loan financing, etc. The way they've done that is by sustainably focusing on large profit pools where they can keep on growing at 20-25%, along with 20-25% sort of ROEs. For example, when they started off with the consumer durable financing business, they captured data of every borrower that they acquired manually, and then they ran a back test on the multiple data points that they could acquire. Over time, the data points that they have started acquiring have consolidated into 10, 15, 20 data points, because now they've realized through their multiple back tests what is the most critical data point that they would require to analyze the repayment capability of a customer. That gives them the quickest turnaround time in the industry. Along with that, they've developed other products which they can cross-sell to existing customers. So the consumer durable financing piece acts as a customer acquisition channel for Bajaj Finance, through which once a customer is acquired, they cross-sell to him personal loans, digital loans, unsecured professional loans, mortgages, etc. And through to lend to these customers under each of these businesses, they've developed separate data specific models. For example, when they started lending to doctors, they developed a data model and a data analytics model which captured data specifically for doctors. So there are 10 lakh doctors in India. They have segregated these doctors into 600 subsegments. And each of these subsegments is based on, for example, which college the doctor graduated out of. Is it a top 20 sort of a medical college? Is it a local medical college? What is the area of specialization for the doctor? Since how long has the doctor been practicing medicine? Which part of India does he practice out of? Is it some part of rural India, or is it Bombay, Chennai, Delhi, Bangalore, etc.? And basis these data models, they've created 600 subsegments, and the decision model runs on these 600 subsegments. The decision being, first of all, the basic decision being whether the person should be lent to or not. The second level of decision making being what is the amount that the person should be given. Is it 20 or 30% of what is asked for, or is it higher? And the third most advanced sort of decision making being what is the rate of interest that he should be lent to. And that is where risk reward comes into picture. So this is what they've done across each and every vertical that they've targeted. Doctors is just one example. And when we combine this with the liability strength of Bajaj Finance to raise money at 4.5 to 5% even during COVID, that is a pretty lethal combination, which say some NBFCs might be able to replicate the low cost of funding. That also maybe a couple of NBFCs only. Some fintech players might be able to replicate some parts of the technological model, but they'll not be able to raise money at 4.5, 5%. And that is the sort of combination that we look for across all our companies. The high barriers to entry that comes with a brand, that comes with distribution, along with the ability to leverage technology at a large scale. And along with all of this, through the 10-year journey, they're just at 1.5 to 2% market share. So there is a long way to grow for Bajaj Finance. And when we are talking about new players entering the market, whether it's through new licenses, whether it's through NBFCs converting to banks, when we talk about even the existing banks, say Kotak Bank or HDFC Bank, they are also, Kotak Bank is at a 2% market share. HDFC Bank is at a 6 to 7% market share. So there is a long room to grow. There is a long runway for all of these banks and NBFCs, a lot of room for them to grow. And I'll give one more example of when we saw a large number of entrants in the banking space, which was 94, 95. We saw UTI Bank, we saw HDFC Bank, and we saw ICICI Bank in 94, 95 come through. And these were names which were prominent even then. These were large trusted names with whom people could have placed deposits. And at that point of time, SBI had 17-18% market share in 94, 95. 25 years hence, all of these banks have done phenomenally well. They've grown at 20-25% CAGR from 0% market share. These four banks combined are at about 20% market share. But at whose expense has this market share come? It's not SBI. SBI even today has a 24% market share. SBI has actually grown market share from the 17-18% it was at. So when we look at new entrants coming in, which I believe actually should be not before the next 2-3 years, if that happens. The RBI governor in the recent MPC meeting said that this is the view of the independent committee. RBI will take its own view whenever that happens. The Banking Act will have to be amended. And then a fit and proper criteria for all these banks, the new applicants will have to be cleared. And if a new entrant comes, that is when we might see the threat of new entrants. But for a bank like SBI, a PSU which was at 17-18% market share, over 25 years it did not lose market share despite the resounding success of these new entrants. So for banks which are at 6-7% market share or 2% market share, I don't believe that that should be a threat, at least for the next 5 to 10 years, the threat of new entrants.
I think just on that, I don't think anybody on this call needs to worry about new entrants. 65% of loans outstanding in the banking system are PSU banks. No PSU bank has delivered a return on equity above their cost of equity in the last 20 years or so. And in effect, every single person on the Zoom call, your income taxes, our income taxes have been used by the government of India to keep these banks going. In the wake of the fiscal stress created by COVID, that clearly is not viable. And hence the logical, rational expectation should be that over the next 10 years, the PSU banks will shed market share as the government stops taking your and my money and sticking it into their balance sheet. So if the PSU banks, which are 2/3 of the banking system, as they lose market share, the private sector will gain market share. Yes, firstly, once the RBI gives new licenses, you could get the new entrants taking some of it. But long before that, the sorts of banks who are inside this portfolio, inside the Kings of Capital portfolio, will be the beneficiaries of the PSU's gradual shedding of market share. Basically, an Air India style demise over the next 20 years spells market share gains for the strong private sector banks. Let's just highlight one other barrier to entry, which is relevant for the savings plays, right? On the savings plays, what you need is reputation and a network. If you just have a reputation, but you don't have a network, our country still isn't so online that the SME owner in Durgapur or Sholapur or Kolhapur is going to log on to the internet and give his life savings away. So you need a physical presence and you need a reputation and a network there. Now, one straightforward example of this actually is HDFC Asset. So one of the most intriguing aspects of our job, and I would argue one of the things which makes our job very interesting, is often the obvious driver of comparative advantage isn't the driver of comparative advantage. So in the case of paints, the quality of the paint isn't the driver of comparative advantage, right? And as we have explained to you over the years, it's Asian Paints' excellence in supply chain in their SAP construct, which gives them the tightest working capital cycle by far in the industry, which is central to driving Asian Paints' comparative advantage. Similarly, in asset management, what returns you've gunned out as a mutual fund, how much you beaten the nifty by, is not actually going to impress the SME owner in Sholapur or Kolhapur. What he's looking for is comfort, that this entity is safe, this asset manager is safe. And what an HDFC asset type brand is doing is, by evoking the brand of the bank, it's giving a sense of safety and stability. Secondly, the banca channel itself, the HDFC banca channel itself is being used, thereby reinforcing the safety stability. And thirdly, all credit to HDFC Asset for doing this. The consistent feedback that we get, not just from distributors of HDFC Assets products, but even from CEOs of HDFC's closest rivals, is that in small town India, in the SME community, by far the greatest demand is for HDFC's products. Even if their equity product guns out 8-9%, people are happy to give them money. They're not really interested in knowing what is the latest, alpha generated by HDFC Top 200. The alpha story is more relevant for the audience that we are facing today. And as a result, you basically bifurcate the asset management market. The mass market, the mass affluent market, the middle class, low middle class market goes to MF. They won't have the 50 lakh corpus necessary to become a Marcellus client. So they go off and join the HDFC Assets of the world. Performance is not the driver there. Network, brand, reputation drives the flows there. And then the class market, so to speak, wealthy people like yourself, you come to the PMS and AIF world, and you look at our performance and the performance of our rivals, and you make your asset allocation accordingly. But the core mass market engine to play the asset management ecosystem will be something like HDFC Asset, very similar to Asian Paints. It's not the performance or the quality of the paint that count. It's other deep-rooted comparative advantages, which will take decades for HDFC's rivals to recreate. It's that what drives HDFC Assets flows. Pramod, back to you.
Yeah, so you sort of preempted my next question. Obviously, we spent a lot of time in talking about lenders in our portfolio, a little bit about the non-lenders. We've talked about asset management, particularly the underlying competitive advantage that we look for in an asset management company. One of the questions that has come up is, I guess if I were to generalize, between industry structure and the unique capabilities of a company, which overrides? For example, why would you invest in HDFC AMC versus CAMS, for example? CAMS has the underlying same underlying drivers in terms of growth for an asset management company. And how does HDFC AMC's unique capabilities, which you partly answered, related to that is, say, the emergence of passive investing or ETFs, which could crunch long-term yields in asset management. How does one justify the investment case in asset management itself?
Okay, let's take them one by one. Tej, I'll deal with this whole market infrastructure piece. If you could deal with the ETFs piece, that'd be fabulous. And then we will do the broader piece around comparative advantages in that, the 40% of Kings of Capital, which are savings plays. What are the comparative advantages? So let me just quickly deal with the market infrastructure plays. We've looked at several of them long and hard, and we've concluded that they have no comparative advantage. They are all the market infrastructure plays, exchanges, depositories, other ancillary providers. You are at the mercy of the regulator. One phone call from the regulator to one phone call from the powers that be to the regulator is all that it needs to snuff out the ROE. It's very rare to find market infrastructure plays in a third world country, in an underdeveloped country, where the regulator will let you earn a significant spread over their cost of capital over long periods of time. It's not tenable from a regulatory perspective to say, I will have depositories or exchanges or other market infrastructure plays which will make tons of money, because the regulator's priority is to push the growth of the market rather than the profitability of market infrastructure plays. So we did a lot of work. Optically, they look very attractive because of the attractive nature of the ROEs they post and the cash flows they generate. But once you look at how the power play works in our country, and you look at how vulnerable they are to the regulatory sand shifting, you realize that it doesn't quite, gel with the Marcellus philosophy of low risk, stable compounding, and hence the avoidance of market infrastructure plays in the Kings of Capital. Tej, over to you for the ETF piece.
Yeah. So there are, in India, there are a few issues why ETFs have not really taken off. First one being liquidity. India is a unique market where on average about 60 to 70% of a company is held by promoters, which is not so in the case of Western economies, which are largely professionally run companies. In India, a lot of companies, most companies in India are promoter driven companies, with promoter stake itself being at 60-70%. Therefore, free float available for passive investing is much lower. Second issue being, in India, still about 50 to 60% of mutual fund selling is done through IFAs. So we've seen over 10 to 15 global asset managers come to India over the past decade. We've seen the likes of JP Morgan, Blackstone, and likes of Goldman. Multiple asset managers come to India and exit because they had the brand, but they did not have the distribution network. Because more than half of India's mutual funds are sold through IFAs, you need to be either a large bank or have a large distribution network, which the likes of HDFC and ITRO and SBI and Axis have had over the past many years. They have the connect, they have the brand, and they have the setup with the IFAs as well. When you are selling through IFAs, if you start selling ETFs, it creates a huge channel conflict. You cannot sell through IFAs. You cannot have ETFs being sold through IFAs, because then you'll not have enough commissions to pay out to these IFAs when you're charging 1 bips or 2 bips or 3 bips on the ETFs itself. So all passive products in India suffer from these two issues largely. HDFC AMC actually was the first AMC to launch an ETF as early as 2009, 2010. over all these years, they've reached a couple of thousand crores in the Nifty ETF, which is the most liquid ETF which you could run in India. And the reason for this is that you don't have liquidity, you won't be able to sell these ETFs through IFAs. And thirdly, the Nifty as a product itself would generate returns which would be much lower than you can generate through active management.
Okay. I know this is a fairly detailed question, but in the interest of time, we can have a quick answer around general and life insurance as well. Just a little bit on both the underlying growth prospects for each of these industries and the barriers to entry for each of these industries.
Just to first set the scene, why are we even bothering with the savings plays? As Tej explained, yes, they are low volatility, but low volatility itself is not going to make any of us on this call compounding, right? Why do we believe that there is a high possibility of solid compounding from the savings plays? The answer lies in what the RBI has been publishing for the last 3 years. The RBI has published some superb work. You can go to the RBI website, download the Household Finance Committee report, showing that 95% of India's household wealth is in physical assets, real estate and gold primarily. The RBI further points out, and we've verified from other sources this is correct, there is no other large economy with this sort of massive skew towards physical assets. The RBI then says this sort of physical asset preponderance does not make sense, and this will change over time. And from our own common sense, our own observations over the last 3-4 years, looking at IDA data, AMFI data, looking at our client base, it's become evident that Indian HNWs have realized that having stuff like real estate, which neither gives you capital appreciation, nor gives you cash flow, nor gives you liquidity, is not obviously a very clever idea, whether it's during an exigency like COVID or more generally. So therefore, that 5% that we have in financial assets, a mere 5%, will clearly change over time. By the way, we have our total household wealth, roughly, nobody has the exact answer, basis what the RBI has published and what other people have published. Our reckoning is India's household wealth is around $10 trillion, right? So that means 5% of 10 trillion, we have a mere $500 billion. 70 years after independence, we have a mere $500 billion in financial assets, right? Jeff Bezos alone has more than that. So you can see why this situation is a bit messed up. Now, at what rate will we financialize our savings, right? So if you make the very conservative assumption that we will move at 1% a year, so 5 goes to 6% next year, 7% thereafter, and 10 years out, we reach the norm for a country at our stage of development, which is 15% in financial assets. That means every year we'll add in the vicinity of $100 billion in financial assets. So where will this go to, right? So the logical place to start is the sort of most visceral, primal need people have, which is, what if I die? What will happen to my family? And how will I save for my old age? So life insurance and pensions, we've got the leading, we've invested in the leading platform therein, HDFC Life. I'll request Tej to give you some color in a minute. Second is, what if I fall ill? We've invested in the best play on health insurance and motor insurance, ICICI Lombard. The third is, how do I generally compound my wealth at a rate ahead of inflation? That's where the HDFC asset play comes in. And the fourth is wealth management, broking. Do I really want to go to a fly-by-night local broker after what I've seen happen at Karvi? Or do I want to go to a reputable, high-quality broker with a strong brand, strong regulation, great fintech platform? So that's the broad layers of the savings plays. Just to sort of highlight, what are the barriers to entry that a HDFC Life has. I'll request Tej to elaborate on that.
So HDFC Life has, on the technology front, similar barriers to entry that a Bajaj Finance has. When doing underwriting, when doing actuarial underwriting, HDFC Life uses the same sort of parameters, same sort of data analytics that a Bajaj Finance uses for lending. The data that they use and the parameters that they use might be different. But for example, HDFC Life, once it lends to a customer HDFC Life, once it sells a protection product to a customer, it will use the same sort of data, and 10 years hence, 5 years hence, will sell to that customer an annuity product. They have internal teams which are bifurcated into cross-selling, into on-selling, into selling to the same customers at the appropriate time. So a customer who is being sold a protection product at 25 or 30, he'll then be sold a product which will involve health insurance, something like a cancer care product, 5 years hence. 10 years hence, he'll be sold an annuity product. then he'll be offered a product for maybe his children. And they also use this cross-sell model, which Bajaj Finance uses in the lending context pretty effectively. So in the case of HDFC Life, they have about 2 to 3 products per customer. The same customer is sold multiple types of pocket insurance or micro insurance at different stages of his life and for his relatives. And the other advantage that HDFC Life has compared to other life insurance companies is the sort of balanced product mix that HDFC Life has. A lot of insurers, even private life insurers in our country, sell ULIPs, which is actually an asset management product, than more than a life insurance product. 70 to 80% of the overall book of most life insurers is ULIPs. Versus for HDFC Life, it is a much more balanced product mix, because of which they are able to navigate through multiple cycles. For example, during COVID, we saw that ULIPs as a product did not take off over the past 6, 7, 8 months. Therefore, HDFC Life was able to gain market share because of its diversified product offering. In the past 6 months, it gained about 2 to 2.5% market share. And that is why, in the context of life insurance, HDFC Life is similar to a Bajaj Finance on the tech front. Secondly, a very diversified product mix, which leads to market share gains through multiple cycles.
Right, fair enough. One interesting question is around timing. We've always recommended timing doesn't help in CCP. Given the relatively higher volatility in KCP, is there a case to time KCP? Let's say there is a second wave of COVID, or FIs suddenly sell out at the same pace if they've come in, and hence, is it worth waiting for a dip?
So, like I said previously, if the longer the time horizon, the less timing will matter. As long as the time horizon is greater than 3 years, the return will mimic the table on the bottom left, which is the 19% return. And let's take an example of a 10-year period. If we believe that over a 10-year period, even if the example that we've always taken in CCP, even if P multiples will halve, but as long as the earnings CAGR is between 20 to 25%, even if the P multiple halves, you'll end up making 18 to 20%. Now with the new offering of STP and SIP, even for investors who do not believe in investing in one shot, even though we've always propagated investing all of it lump sum together, we've always propagated that timing does not matter. Even if investors want to invest over a period of time, over a 3, 4, 5 months period, and take timing out of the picture, with the launch of SIP and STP, investors have an option to do that in KCP as well as CCP.
Great. One last question before we handle a few questions on SIP is the quarterly performance of KCP, given that this is a KCP webinar. Any short summary you can give around the performance of the portfolio stocks in terms of earnings?
Yeah, sure. So across the non-lenders in our portfolio, whether it's asset managers, life insurers, general insurers, brokerages. So the brokerage business has been doing pretty well across the industry. The brokerage business, which we own in our portfolio, grew earnings upwards of 80-90% YOY. We've seen that the industry itself has grown by 40-50%. The business that we own actually gained market share during this time. During the past quarter, when they've grown earnings at 100% plus. Because it's not a leverage business anyways, it was doing pretty well during COVID as well. The distribution business has been also doing pretty well for the wealth managers that we own. Coming to the life insurers, we've seen life insurance awareness grow through the COVID crisis. Over the past 6 months, we've seen that HDFC Life has actually been growing at 30% plus. In April, May, the growth was a bit lower. But in August, September, October especially, they're growing at 30-40% plus. And they have also been gaining market share because, like we discussed, a lot of other life insurers have been selling ULIPs, and customers through the fall of March, April, May have lost confidence in ULIPs. So the HDFC Life is also gaining market share. ICICI Lombard has it was the largest private insurer. It's consolidating even further with the acquisition of Bharti AXA. They'll further improve their market share in the general insurance industry. Their claims have been lower than what everyone expected over the past 6 months because motor insurance claims have been lower. On the health insurance front, where the concern has been because of COVID, they have reserved appropriately even after the excess reserving. They've not released reserves yet. Even after the excess reserving, they've delivered ROEs of 20% plus over the past 6 months. And they've been very conservative in reserving, which we can see through the reserving triangles of the past 10-15 years. And they'll not be releasing reserves till the end of this year, till they have a clear idea of where COVID is, where the vaccine is going to be. But it's not a cause of concern. Earnings growth has been north of 20%. PBT growth actually was 35%. ROE was 20% plus. On the lenders in our portfolio, we showed the overall picture where we stand. We are well capitalized, 17-18% tier 1. Along with moratorium numbers which are receding day by day, month after month. Collection efficiency for these lenders post the moratorium is 95% plus for most of them. So HDFC Bank, Bajaj Finance, Axis Bank, or Kotak Bank, all of them have been at 95% plus on collection efficiency. As the dispensation lifts, we'll see what the actual GNPA numbers are. But a lot of these lenders have disclosed pro forma GNPA numbers in the September quarter. We'll see what the numbers come out to in the December quarter, but we are not very worried given that we are mostly out of the woods over here because they've also provided for what they needed to provide for, and capital is enough in case there is any excess provisioning required. So in terms of expectations, we are much better off than what all of us expected in April, May, June. And in terms of provisioning also, we are much better off than what the worst case expectations were. So at a portfolio level, we are much better off than we expected ourselves to be in April, May, June on the lending as well as the non-lending side. And we should expect to be back at the 19-20% earnings level from FY22 onwards.
Great, thanks. Thanks, Tej. So just moving on to some questions related to SIP, given that we talked about it right at the beginning of this call and some of you joined late, we'll reiterate the thoughts. First of all, for staggering your investments, STP is a better option. STP, which we launched 2 weeks ago, systematic transfer plan. So if you're worried that the market is at its peak and therefore there is a possibility of a fall, but you're not sure yet, you want to put your money to work, but gradually so, then the systematic transfer plan is the product for you, particularly if you're a new investor where the minimum requirement is 50 lakhs. And as you know, at Marcellus, we don't attempt to time the market. If you give us 50 lakhs, we literally put the money to work the next day. The STP allows you to give us the 50 lakhs, but we'll put only 10 lakhs into the underlying portfolio, whether it's CCP or KCP. The remaining 40 lakhs will be put in a liquid fund. And every month on a prefixed date, 10 lakhs will be redeemed from that liquid fund and invested in the underlying portfolio. That is systematic transfer plan. Whereas systematic investment plan is meant to have a disciplined approach towards savings. If you're sitting on a lump sum amount of money, we've always maintained that you're better off investing it in one go, or at best you get into a systematic transfer plan. However, if you are a salaried professional or a businessman with consistent dividends as inflows or whatever it is, but you want to ensure that as soon as you get those cash inflows, which translate into savings post your expenses, you want to ensure that savings are allocated to the right assets based on your asset allocation, which could include a Marcellus CCP or a KCP portfolio. You can get into an SIP where the rules are you should have a CCP or a KCP portfolio where you've already invested 50 lakhs to qualify for an SIP. Once you qualify, the minimum investment on a monthly basis is 2 lakhs. You can invest in sort of multiples of 50,000 thereafter. Therefore, you can get into an SIP of 2 lakhs a month or 2.5 lakhs a month or 3 lakhs a month, so on and so forth. And for as long as you wish, but with a minimum of 5 installments at the time of signing up. And we automate this entire process, make it easy. You don't have to bother transferring this money from your bank account to the Marcellus PMS account. It is through the typical ECS facility and auto debit facility, which many of you will be familiar from the mutual fund experience. And that way, you don't have to go after, okay, now I've suddenly accumulated so many savings in my portfolio, which have been lying around in the savings account, obviously suboptimally deployed. As soon as the savings accumulate, you can trigger the SIP and they get allocated to your favored PMS. And as soon as we get the money, we deploy it into the underlying portfolio. So one other clarification is, if you're a CCP investor with 50 lakhs in CCP, can I start a KCP SIP? No, the SIP can be started in the portfolio in which you have 50 lakhs only. So if you want to then do an SIP in KCP, first you need to invest 50 lakhs in KCP, and then you're eligible for an SIP in KCP as well. Lastly, more on looks like an ideological question about. Okay, so we have one more question. How is the SIP different from a top-up? No, SIP is the same as a top-up. Top-up is something that you do at your discretion when you feel like. We're only creating a system and a process where that top-up happens automatically. So we get an ECS form signed by you, which we submit to your bank, and the money is debited from your bank. You don't have to bother. Sometimes most of us slip, and that's what I was referring to, while the savings tend to get accumulated in your bank. Instead, they're automatically put to work. The ideological question I was talking about is, are we launching the SIP because we are expecting a market fall? No, that's not at all the case. I'm not saying that we are not expecting a market fall. We have no idea. We've always maintained that we tend to do very poorly in terms of timing or second guessing where stock prices will be tomorrow, day after, and so on and so forth. All we are suggesting is, in an upward trending asset class like equities in general, within which CCP and KCP are relatively less volatile, and therefore if you're investing with a longer term horizon, you're bound to get decent returns or healthy returns irrespective of what time you invest in. We're only providing you an opportunity to get those investments to work, get your money to work for you as quickly as possible, without having to wait for the right time or so on. That's the only reason. We have no idea where the market will be tomorrow or a month from now. We focus all our energies in understanding where the businesses or the companies that we invest in are headed from the investment horizon perspective, which is 3 years hence. What will be the earnings growth over the next 3 to 5 years for these portfolios? And as we have shown in both this and the CCP webinar earlier, if you're investing in businesses and companies which are likely to give you that 18, 20, 25% sort of an earnings growth over the next 3 to 5 years, your returns are more or less likely going to be in that vicinity, irrespective when you start that investment. You're very, very unlikely to see a company which delivers a profit compounding of 20% for the next 5 years and you end up with a return of minus 20%. Nor is it very likely that you have an earnings compounding of 20% and you get a 100% CAGR for the next 5 years. Instead of 20%, you might get a 15% because, let's say, there is a structural slowdown in India, or there's a global dry up in liquidity of sort. Or if you get lucky, where there is a Goldilocks scenario, companies with a 20% earnings growth might give you a 25% return. But that's the sort of margin of safety we're looking at. We're focusing on our energies on building confidence and conviction in the companies that we invest in without having to time the market. And the last question is on Marcellus promoters investments. And I must disclose this. All the Marcellus promoters, there's a rule within Marcellus. All our equity investments has to be in Marcellus products only. We are not allowed to invest directly in stocks. nor in any other PMS or mutual funds as far as equities are concerned. Of course, we all have our savings for a rainy day, or emergency funds where we might have invested in a bond fund or a fixed deposit. But as far as our equity exposure is concerned, all the promoters have all their investments in Marcellus funds only. There have been a few more SIP related questions. I'm trying to see if we have answered all of them. Okay, there's one non-SIP. Can I put my 50 lakhs equally in all three PMS schemes? Unfortunately not. We'll need at least 50 lakhs in each of our schemes. In any case, Little Champs is closed for fresh inflows, barring any redemptions where we might call upon the people who have expressed interest in the part. So we effectively have only two PMS schemes which are open for investments, and we will need 50 lakhs in each of those schemes. All right, I think we have covered most of the questions and we're running out of time. So, thank you so much for everybody for dialing in once again. As usual, the recording will be put up on our website in the video section where all our webinars are stored anyways. And you can also catch the recording on our YouTube channel under Marcellus Investment Managers. Many thanks once again. Many thanks, Tej and Nitesh.
Thank you.